In this episode, we're going to look at how to transition from mutual funds, ETFs, and index funds to individual dividend stocks. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. This episode is divided into the following 4 sections. First, we're going to look at our approach to investing. Then, we'll take a look at a current portfolio from one of our listeners. And then, we're going to take a look at how to transition from that portfolio to individual dividend stocks. And then the last topic in this episode, we'll be looking at how to diversify your portfolio. So let's get started with our first topic, which is our approach to investing. And as you've seen before in past episodes, our approach has not changed. And this is to help you build a resilient portfolio that provides growing income each year. Now, the key words here are resilient and growing income. We want to make sure that your portfolio is resilient enough to withstand any market downturns or market crashes or even a recession. And then we want to make sure that the portfolio continues to provide you with not only income every year, but to grow that income every single year. So how do we do that? And so we do that by helping you to invest in quality dividend paying stocks when they are priced low. And the key here is quality dividend stocks, not just any stock that pays a dividend, but it has to be a quality stock. And not just at any price, we want to make sure that it's priced low. Stock prices go up and down all the time. The best time to buy is when the stock is undervalued, not when it's overvalued. So how do you know when you're looking at a stock anywhere in the world if it's a quality stock and if it's priced low? So to help you with that, I've created what I call the 12 rules of simply investing. This is going to be our checklist in today's episode, and it should be your checklist anytime you're looking to invest in dividend stocks. So if a company fails even one rule, we skip it, move on to something else. In order to be a quality stock, it has to pass each and every one of these 12 rules up on the screen. I'm going to go through these fairly quickly right now, and then we'll move on to our next topic in this episode. So rule number 1, do you understand how the company is making money? If not, skip it, move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is the company recession-proof? And rule number 5, is the company profitable? Rule number 6, does the company grow its dividend? Rule number 7, can it afford to pay the dividend? And rule number 8, is the debt less than 70%? And rule number 9, we want to avoid any company with recent dividend cuts. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? And rule number 12, keep your emotions out of investing. And there you have it. Those are the 12 rules of simply investing. And these become our guiding principles whenever we are looking to invest in dividend stocks. Like I said before, if a company passes all of these 12 rules, then you know that you're looking at a quality dividend paying stock and the stock is priced low. So now let's move on to our next topic in this episode, and this is to look at a current portfolio from an actual listener that came in to me recently. And so our listener and reader of the podcast has provided the following information. So their entire current portfolio is made up of only 3 index funds. So you can see it up on the screen here. They have a total US index fund, they have a total international index fund, and a total bond index fund. So they didn't specify which company these funds were with, and there are lots of companies out there that offer these types of index funds. So in today's episode, just to keep it simple, I am going to use Fidelity as an example. And Fidelity has the exact same funds that this person had sent to me by email. So you can see the total market index, that's the US index fund, is right there. You can see up on the screen we have the fund symbol from Fidelity. We also have the total international index fund and the total bond index fund. All the companies have different fees related to these types of funds. A lot of companies have the same type of funds available to you. I just used Fidelity as an example for today's episode. In fact, their fees are pretty low when you compare them to some of the other companies that are out there. So this viewer also indicated that they had a total of $600,000 invested in their portfolio across those three funds. And their money currently is sitting in a Roth and an IRA. It's spread out between those two different accounts, but the total amount, the market value today, is $600,000, and it is in those three index funds that I just mentioned. Now, if you're from Canada, you could be in a similar situation, for example, in an RRSP or a TFSA account. So the strategies that we're going to discuss in today's episode can be applied in Canada as well, in the US as well, and probably in other countries, but I'm going to leave that up to you as the viewer, depending on where you're based, if there are any tax implications or not. But for now, we're going to leave all of those out of it. The money in this example will stay in a Roth account or an IRA account, but it will be moved into a stock trading account. Same thing in Canada. You can open up a RRSP or a TFSA stock trading account. So as long as the money stays within those accounts, there are no tax implications. So let's continue. The other thing the viewer did not email to me was the distribution of their money across the three funds. So I'm going to keep it simple, and I'm going to assume it is equally distributed across the three funds. So you can see up on the screen here, we're going to assume that they have $200,000 in the market index fund, $200,000 in the international index fund, and $200,000 in the bond index fund. Now, there are lots of pros and cons to investing in index funds. So I'm not going to cover all of them today. I encourage you to go back and watch episode 60. Go back and watch that episode where I cover in detail what are index funds, what are the pros and cons to investing in index funds versus individual stock investing. So that's all covered in episode 60, and I encourage you to go back and watch it if you haven't seen it already. So today's episode, let's keep it simple. We're going to focus on two important issues here with the current portfolio. And so one of them has to do with the fees. As I mentioned before, each of those index funds, including mutual funds and index funds and ETFs, they all have an annual fee. The annual fee is deducted automatically from those accounts, from those funds, every single year. And that is to cover the cost of the company's overhead, management of the funds. If there's a fund manager, that pays their salary as well, any employees and staff, office space, marketing, all of the costs have to come out of the fee itself. So the two big issues that we're going to see here, and there's other ones, but the two big ones with the current portfolio is going to be the fees that this person is currently paying in their portfolio, and then a lack of sufficient income. And that was the big driver when the person sent the email to me was, I want to transition to a dividend stock portfolio where I can earn more dividend income from my portfolio than they're currently getting. So we're not going to spend too much time, but let's take a quick look at the fees, and then we'll look at the lack of sufficient income. So in this example, you can see up on the screen, we're going to use our mutual fund calculator from our friends at nerdwallet.com. You can see the URL right there. I encourage everybody, go check out the calculator. You can enter your own numbers in there, and it will tell you what the fees are costing you in your investments. So I'm going to make two assumptions here. Future contributions, you can see I've set it to 0. So I'm assuming that this person is not going to add another penny to their retirement fund. In this case, the Roth and the IRA. They've got $600,000 today. They're not going to add another penny at all, and we'll see what the fees look like. If they were to contribute, and most people do contribute regularly to their retirement fund, the fees will be much higher. The rate of return, if you look at any textbook over the last 70 years, 80 years stock market history, the rate of return, average rate of return has been anywhere between 8 to 12%. So in this case, I'm going to use 8.5%. Again, if I use a higher number, the fees will be much higher. So anyway, we're going to stick with these assumptions. Future contributions, we're going to assume are 0. And the rate of return, we are going to assume is 8.5%. And so let's take a look. When we plug the numbers in, we can see for the total US index fund, like I said before, the person has $200,000 invested in that index fund. The MER is 0.015%. So over 20 years, if they were to leave the money in there, and don't touch it, don't add any more new money to it, just leave it in there, after 20 years, they would lose $2,823 to fees. After 40 years, they would lose over $28,800 to fees. Let's move on to the next one. The total international index fund has an MER of 0.06%. Again, this is an example. I'm using Fidelity funds. If you have funds with a different company, find out what the MER is, and you can plug that into the mutual fund calculator. Okay, so let's continue. The total international index fund after 20 years is going to cost this person $11,248 in fees. After 40 years, it's going to cost them $114,000 in fees. Now let's move on to the last fund, which is the total bond index fund. Again, the amount invested is $200,000. The MER is 0.45%. And after 20 years, this person will have spent over $81,000 in fees. After 40 years, it's going to be over $800,000 in fees. Now, that's not a mistake. I verified the number twice. I encourage you to go yourself to the mutual fund fee calculator at our friends at nerdwallet.com. Put the same numbers in, and you'll see that $200,000 invested in an index fund that has a MER of 0.45% after 40 years will cost you over $800,000 in fees. If we add up all the numbers, you can see that after 20 years, the total portfolio will have spent over $95,000 in fees. After 40 years, it's over $943 in fees. That's almost $1 million in fees. Now, I know what some of you are thinking, and you are correct. The $600,000 is going to be worth a lot more in 20 years. And in 40 years, it's going to be worth even more. And that's fine. That's probably true. That's what's going to happen. It's going to grow in value. The point I'm trying to make here is that I would rather you save that amount of money spent on fees. How do we bring that down? How do we bring it down to almost 0? And the rate of return, even with dividend stocks, you're looking at approximately the average rate of return for the US market, for example. And how do I know this? We can just take a look at the Dow 30. The Dow 30 list of companies closely tracks the broad US index market. Now, it's going to be not exact. It'll be off here and there, but it's going to be close enough. So you don't need to own thousands and thousands of different companies. You can own just a handful of companies and with the right selection of companies, still make a decent amount of market return. But if you do that yourself with individual stocks, then you can save, in this case, almost $1 million after 40 years in fees. So just saving the fee alone will put you ahead automatically. So now let's move on to the next subject in this topic we were looking at, and is the lack of sufficient income. So this person, again, we're going to look at the same 3 index funds. Let's start with the US index fund. Again, they've invested $200,000. Okay. The yield currently, as far as I can tell from Yahoo Finance, is 1.31%. So if we calculate the 1.31% of $200,000, you can see that the annual income this year from the US index fund is $2,620. Now let's take a look at the international index. It has a higher yield of 2.62%, and you can see the annual income is $5,240. Now we take a look at the bond index. Again, $200,000 invested. It has a much higher yield of 4.37%, and the annual income is $8,740. If we add it all up, you can see that the $600,000 investment today in the 3 index funds that you see up on the screen is going to generate an annual income of $16,600. Now that might seem fine to you. However, we have 2 goals here. Number 1 is to reduce the amount in fees, which we saw was almost $1 million after 40 years. And the second goal is to grow the dividend income. Let's see if we can take the same $600,000 and if we can make more than $16,600 in income. Let's take a look. We're going to continue in this episode here, and we'll see if we can generate more income with individual stocks as opposed to staying invested in these 3 index funds. So how are we going to do that? Again, we're going to follow the 12 rules of simply investing. We're going to select quality companies that are priced low. So let's move on to our third topic in this episode, which is now taking a look at how to transition to dividend stocks. And remember, not just any stock, quality dividend paying stocks when they're priced low. So there's 4 steps to this process. Step 1, you need to open a trading account. Now this could be a Roth trading account if it's available, an IRA trading account. In Canada, we'll have the RRSP, TFSA, or non-registered accounts. So that's outside of any of those accounts. So that will, step 1, it means you need to open a stock trading account because that's where you're going to be able to buy and sell stocks. And that's where the dividends, the money that's coming to you for being a shareholder, is going to get deposited into the stock trading account. Step 2 is then to transfer the funds into the account that you just opened up. And so that is handled by the financial institution. In this case, our viewer has $600,000 in 3 different index funds. They would submit a request to take the $600,000 and transfer the money from those accounts to another Roth or IRA stock trading account, right? Same thing in Canada, RRSP. You could keep the money in the RRSP. You don't need to take it out because you don't want to incur taxes, but you could transfer the money in your current RRSP to a stock trading account RRSP. Okay, so you've got to transfer the money over. That's step number 2. Step number 3, identify quality dividend stocks that are priced low. And then step number 4, you invest in those stocks. So I'm going to skip right away to step number 3 because that's what we're talking about in today's episode. So how do you do that? Right? How do you identify quality dividend stocks when they're priced low? Again, we're going to use the 12 rules of simply investing to help us identify those stocks. There's thousands and thousands of stocks in the US and in Canada and all over the world. we need to narrow that list down to a small subset of stocks. So how do we do that? We apply the 12 rules of Simply Investing. Now, I cover these in detail in the Simply Investing course. I also provide you in the course with a Google spreadsheet, and you can enter all your numbers in. The Google Sheet will highlight which rules the company passes, which rules the company fails, and then you can narrow the list down from thousands of stocks to maybe just 5, 6, 8, or 10 stocks. The other option is the Simply Investing platform, which applies the rules to over 6,000 companies in the US and Canada every single day and tells you which ones pass or fail. So you're gonna do that either through the course or using the platform, and you're gonna narrow the list down of stocks. So then the question is, how many stocks should you own? And the short answer is anywhere, on average, from 25 to 50. Anything more than that, it's going to be difficult to manage for you. I don't want you to go out and buy 500 stocks in 500 different companies, because then you might as well just own an index fund. And if you buy too many companies, not all of those companies are going to have quality stocks, and not all of them are going to be undervalued today. So we want to keep it on average between 25 to 50. Now, back to our current portfolio that we're helping our viewer with. The viewer has $600,000 now to invest. So they have a couple of options. You can divide that up by 10 into 10 different companies. So that means you'd be putting $60,000 into each company. Or you can divide it by 20 and put $30,000 into each company, or divide it by 30 companies and put it into 10. So you see what I'm getting at. There's no hard or fast rule about how you divide up the money. So you can divide it up across 50 companies if you'd like. But I think anything more than that will be too much. So you want to find a good, reasonable amount that you're happy with. So in this example, and again, we're all about keeping it simple, I'm going to go with 20 companies. So we're going to take the $600,000 in this hypothetical example, and we're going to invest it across 20 companies, which means we're investing $30,000 each in those 20 companies. So here up on the screen, you can see the list of companies. Okay, so keep in mind, this is an older list. I have not applied the 12 rules of Simply Investing to this list today as of this recording. This was a list that was done a while ago. At the time, the companies passed the 12 rules. Okay, so this is not a buy list for anybody watching this. This does not mean you should go ahead and buy these companies. And especially if you're watching this video much later than when it was recorded, again, you don't want to be buying the companies on this list without applying the 12 rules of Simply Investing first. So like I said, this is an older list. It was done a while ago. It was combined with another previous list from over a year and a half ago, maybe even 2 years ago. And what I'm trying to show you here in today's episode is what a typical dividend stock portfolio would look like. So here is the list of 20 companies. We're going to assume that we've applied the 12 rules. These companies passed the 12 rules, and now we've got a list of 20 dividend stocks. Now, what we've done is we've split up. You could see the next column is the quantity of how many shares we're going to buy in each company. And you'll see in a minute why we decided on these quantities. Here you can see the share price. This is, again, only valid as of this recording because share prices change every single day. Then we have the dividends listed out, the dividend per share. This is the annual dividend per share. Okay, if we multiply that, divide the dividend by the share price, we can get the dividend yield, right? So now we know what the companies are providing you as an annual dividend yield. That's the return on your investment while you hold on to those shares. The next column is the annual dividend income. So you can see that we've got it listed out. And finally, the last column is the market value. As I said before, we're dividing the money equally across 20 companies. So you can see that it's approximately $30,000 in each company. And if you look at the total at the bottom, you'll see we have $600,000 invested total. If you take a look at the annual dividend income, you can see that if the person was to go ahead and buy these 20 companies in the quantity that we've shown, they would make over $20,279 in dividends in 1 year. And so this portfolio is currently giving us a yield of 3.38%. Okay, so let's now compare this to what we were getting with the 3 index funds. So we're going to compare the index funds to the individual dividend stocks. So the amount invested is going to be the same. We're not adding any new money to the dividend stocks. So in both cases, we have $600,000 invested. You can see that the fees for this year alone in the index fund will be $1,050. So basically $1,000. For the dividend stocks, I'm going to assume that the stock trading account is charging you a commission, a trading commission of $9.99. A lot of places charge less than that, and now there are some places that charge $0 for commissions. But in this case, we're going to stick with $9.99. So you can see it is $199.80. So roughly $200 is the commission fee to place an order for the 20 stocks that I've shown you on the previous slide. So $200 in dividend, the fee for dividend stocks versus $1,000 for the index funds. Now watch what happens to the fee after 40 years. As I showed you before, for the index funds, the fee will be, and we've adding up the fee every year for the next 40 years, will come out to over $943,000. That's almost $1 million lost to fees. And what is the fee after 40 years if you were just to hold on to those same 20 stocks? Well, the fee doesn't change because that is a one-time fee when you place an order to buy shares. Now, if you want to sell them, then of course they're going to charge you again a commission trading fee of $9.99, or maybe less than that, or like I said, some places don't even charge a commission anymore. But in this case, after 40 years, if you just held on to those shares, your fee has not changed. So it's still $199.80. That is a stark contrast and a huge difference from $199 to almost $1 million lost to fees. Okay, so that is a huge impact, has a negative impact on your portfolio. Now we take a look at the annual income just for this year. So the index funds, like I showed you before, if you just held on to them, will generate $16,600 in income this year. The dividend stocks, as we've just seen in the previous slide, will generate over $20,279 in annual income. Now remember, we haven't added any more money to the account, but yet we've grown the income by more than 22% just by taking the same amount of money and taking it out of the index funds and moving it to dividend stocks. So that is a huge increase in the annual income. Okay, so the other benefit with dividends is that there's no need to sell your shares. The goal is to eventually live off of the dividends, so you never have to eat into your capital. Without the dividends, you are going to eventually have to sell your shares or sell your ETFs or index funds or mutual funds to be able to generate the kind of money that you can get with dividends. Because as you've seen in this example, the yield is much lower on index funds, and it's going to be the same with ETFs and the same with mutual funds. And the other advantage with dividends is you get to take advantage of dividend increases. Every time the company increases the dividend, that's more money in your pocket. Let's take a quick look here. Coca-Cola has consecutively increased their dividend for more than 62 years. If we take a look at Colgate-Palmolive, has had more than 60 years of consecutive dividend increases. Think about how many market crashes and how many market downturns we've had in the last 50, 60 years. But companies like these have continued to not only pay a dividend, but to grow the dividend consecutively for more than 6 decades. And so every time they increase the dividend, that's going to be more money in your pocket. So now you might be wondering, well, how much can you earn? Right? We've seen the numbers for this year, but what does the future look like? How much money can you earn over the long term? So for this, we're going to use our future value Google Sheet. I'll put a link below in the description. It's free to download. There's no charge. We don't even ask for an email address. Just click on the link. You're going to be able to go to the Simply Investing website and download the Google Sheet and try it out for yourself. In this Google Sheet, I highly recommend you put in your own numbers and see what it comes up with. So in this example, we're going to stick with our viewer who had sent us the email. And so the starting balance at the top left-hand corner is $600,000. The next column over to the right, again, I'm going to assume no additional future contributions. So we're going to leave that at 0. You can see the dividends earned annually. It's exactly what we just showed you, $20,280 in dividends. The dividend yield, I'm going to keep it the same, 3.38%, like we showed you with the 20 companies that we had a couple of minutes ago up on the screen. And the stock price growth, I'm going to leave it at 5.5%. You can change it to 8% if you want, 10 or 9 or any number you want. We're going to leave it at 5.5. And you can see that roughly by the time you get to the 9-year mark, the dividend income will have doubled. And this portfolio after 30 years will be worth over $7.7 million. And interestingly enough, by the time we get to the 20-year mark, the portfolio is now generating over $100,000 in dividend income each year. So this is what the future value spreadsheet looks like. Again, these are estimates. These are based on a number of assumptions, but you're free to try it yourself and enter your own numbers in. I tried one more scenario where we stuck with the starting balance of $600,000. In this case, we tried to make it a little more realistic. This person's going to add $5,000 a year to their retirement fund. Okay. Stock price growth, we're going to increase it a little bit from 5.5% to 6%. Everything else stays the same. And now you can see that by around the 8-year mark, the dividend income will have doubled. And at the 18-year mark, the portfolio is generating over $100,000 a year in dividend income. And the portfolio itself, after 30 years, will be worth over $9.6 million. So the other question is, should you transition immediately? Meaning, sell the index funds, take the cash, and invest all of it in individual dividend stocks? And the answer is no. The key is you want to do it gradually. The reason for that is we don't know, and I don't know, what's going to happen in the stock market next week, next month, or next year. Is the market going to go down? Is there going to be a market crash? Or is the market going to go up and up and up and even higher? So the way to minimize your risk is to invest slowly. In this case, the person has $600,000 to invest. Perhaps a good strategy would be to invest $100,000 now, wait a month, invest another $100,000, wait a month, invest another $100,000, and then do that. So it'll take approximately 6 months to get all of the money invested. What you want to do is when you're ready to invest, apply the 12 rules and see what is priced low at the time. And then next month, do the same thing. Perhaps the list might change. You might have other companies that are undervalued at that time. And then in the 3rd month, do the same thing and keep doing that till you've invested all of your money slowly. We want to invest slowly because if the market tanks, well, then you're going to be able to buy cheaper stocks in the future, in the next month and the month after that and the month after that. If the market starts to go up, well, now you're going to be at least investing today and taking advantage of the lower prices today, and then prices could go up. But this is a way to minimize your risk. You invest slowly over time. If you want it to go a little faster, you could do 100,000 now and maybe wait 3 weeks, and then do another 100,000, then wait 3 weeks, 4 weeks, and then do it again. Just slowly over time. Okay, our last topic is the question of diversification, right? Why do we need to diversify our portfolio? And the biggest reason is to minimize our risk. You don't want to put all your eggs in one basket. For example, you don't want to put all of your money in financial and banking stocks. Remember what happened in 2008, 2009 financial crisis? If all of your money was in bank stocks, your entire portfolio would be down completely. And if the banks started cutting dividends, which they did back in 2008, 2009, well, now your dividend income is going to go down. So we don't want to put all your eggs in one basket. The key here is over time to invest across the 11 sectors you see up on the screen right now. And those are energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, utilities, and real estate. So keep in mind, you are not going to be able to diversify your entire portfolio in day one. This will take time. It can take anywhere from 3 years to 5 years. Over time, you will start to invest in companies, like I said, only when they're undervalued. So maybe today, not all utility companies are undervalued. So then you don't invest in them now. You take some of the money, like I said, we don't want to invest everything in one shot. You take the money you have to invest now, invest it in what is undervalued today. Then in the future, when you have more money to invest, take a look at what's undervalued then, and then invest in that. And then you can take a look at what you currently own and say, okay, well, I've got enough money invested in financials. I'm not going to buy any more financial stocks right now. And you would look at other sectors, other companies in those sectors that are undervalued at that time in the future. So again, it's going to take 3 to 5 years. It takes time to build a well-diversified portfolio. So give yourself the time and be patient with yourself as you diversify slowly across these 11 sectors. You're not going to be able to do it all in one day. Reminder is to invest for the long term, right? This is money that you do not need in 5 years or less. The longer you can stay invested, the better off you'll be. You're going to be able to lower your risk. You're going to be able to grow your dividend income and reinvest those dividends into other dividend producing stocks. So this is fantastic approach if you can invest for 10, 15, 20, 30, 40 years over the long term. And that's how you're going to get the most gains. So remember, our approach is to invest in quality dividend-paying stocks when they're priced low. And how do we know when they're quality stocks? And how do we know when they're priced low? We apply the 12 rules of simply investing. So I've already covered these at the beginning of the episode, so we're not going to go through them again. You can see all 12 rules up on the screen. For anybody that's interested, I've created the Simply Investing course, which covers all of the rules and approach to investing. It's a video course, self-paced, and we cover the following 10 modules. Module 1 will cover the investing basics. Module 2 will cover the 12 rules of simply investing. Module 3, you will learn how to apply the 12 rules. Module 4, I'll show you how to use the Simply Investing platform. Module 5, placing your first stock order step by step. Module 6, building and tracking your portfolio. Module 7, when to sell. Module 8, reducing your fees and risk, especially when it comes to mutual funds, index funds, and ETFs. Module 9, your action plan for getting started right away. And Module 10, I answer your most frequently asked questions. We also have the Simply Investing platform that I mentioned earlier. The platform tracks over 6,000 companies in the US and Canada every single day, and it applies the rules to those companies so you can quickly see which companies to avoid and which ones to consider. If you're interested in the course or the platform or both, you may want to write down the coupon code SAVE10, SAVE10. It's going to save you 10% off of the course and the platform itself. If you enjoyed today's episode, be sure to hit the subscribe button. Hit the like button as well. We have a new episode out every week. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.